Is America quietly starting a war on foreign money? America just opened a dangerous new front, not with tariffs, but with taxes. A little-known clause in the latest Republican budget could quietly trigger a global financial shakeup, hitting pension funds, foreign governance, and even global markets. It could be more destructive than tariffs, and it's buried deep in the fine print. What's going on? And why could this reshape the future of global investment? America has long relied on foreign money and foreign investors have relied on America. But new proposals in the Republican budget are threatening that relationship. Under an obscure rule known as Section 899, the U.S. Treasury Secretary would gain sweeping powers to tax interest, dividends, and rent sent to investors from countries with so-called unfair tax systems. The rate starts at 5%, but it could rise to 20%. That means reduced returns for foreign pension funds, governments, and individual investors who have invested heavily in U.S. assets. Another clause would impose a 3.5% tax on any remittance sent abroad by non-citizens. Foreign workers, companies, and investors would all be affected just from moving their money. This is a new front in the trade war, potentially more damaging than tariffs. While America's economy is less reliant on trade, it is heavily dependent on foreign investment. Foreigners own $62 trillion in U.S. assets, while Americans hold only $36 trillion abroad. That's a net imbalance of nearly minus 90% of GDP, the largest of any major developed economy. About one-third of U.S. government debt, nearly $9 trillion, is held by foreign investors. This is a risky time to discourage foreign capital. The budget proposal also cements previous unfunded tax cuts, pushing America toward chronic government borrowing of 6 to 7% of GDP annually. U.S. Treasuries might be exempt from the new taxes, but even the uncertainty may scare off investors, especially amid growing global skepticism following recent policy disruptions. This approach could destabilize the global financial system. Countries can find alternatives to American goods, but access to U.S. capital markets is harder to replace. American stocks make up 60% of global equity markets, and the dollar is still the dominant reserve currency. Losing access to U.S. investments would reduce diversification, distort capital flows, and ultimately make the global economy less efficient and poorer. Some believe Section 899 is just a negotiation tactic or retaliation for other nations' digital services taxes targeting American tech firms. But even limited taxes tend to grow. And in Washington, there's little political will to defend the interests of foreign investors. This isn't just a tax debate, it's a warning sign about where the global economy is heading. Subscribe for more economic, business, and political news, and for thought-provoking insights that go beyond the headlines.